Welcome to The Explainer. Today, we're jumping right in to decode the high-stakes, high-drama world of earnings season.
And look, this isn't just some hypothetical situation. It's the reality that plays out 4 times every single year in the financial markets, sending ripples through portfolios big and small.
So what's behind all this chaos? Well, the answer lies in one powerful recurring event that every investor, and I mean every investor, watches like a hawk: earnings season.
Okay, so let's get right into the power of this season. We're going to break down why these few weeks can literally define an entire year for your investments and for the market as a whole.
Think of it like a company's official report card. It's that moment of truth, you know? It's a crucial reality check that separates all the speculation from actual performance. This is where we see the cold, hard data.
And this whole cycle, it happens like clockwork, 4 times a year, kicking off a few weeks after each financial quarter wraps up. You'll want to mark your calendars because these are the months when market volatility can really pick up.
But what are the actual mechanics here? I mean, how can a single report trigger such dramatic, almost instant swings in a company's stock price?
Well, it all comes down to one single thing: expectations. You see, before a single number is even released, Wall Street has already set the benchmark. Analysts create this consensus forecast of what they expect the company to earn. So the real drama isn't just the number itself, it's how that number performs against the script that's already been written.
And wow, you can really see the consequences laid out so clearly here. A beat, like the example with Rolls-Royce, often earns a nice boost. A miss, like with the UK bank, gets punished swiftly. But look at the middle. Meeting expectations often does absolutely nothing. Why? Because the market is so forward-looking that just meeting the target is the bare minimum. It's already factored into the price.
This points to a really crucial nuance. Investors are always looking ahead. So while past performance is important, what can matter even more is the forward guidance. That's the company's own forecast for what's coming next. A rosy outlook can make investors forgive a weak quarter, and vice versa. Let's walk through a classic scenario to see this in action. Imagine a tech firm reports solid earnings for the previous quarter. Everything looks good, so investors should be happy, right? Wrong. The stock plummeted 10%. Why? Because while its past performance was good, the company issued a warning about its future, citing supply chain issues. That weak forward guidance completely overshadowed the solid earnings. So let's zoom out and see how all these individual company stories build into a big picture for the entire market. Because this isn't just about one stock. It's a barometer for the health of the whole economy. I mean, think about it. When major companies across different sectors all report strong earnings, it sends a powerful signal that the economy is healthy. Central banks watch this data super closely when deciding on interest rates, and positive reports can lift entire sectors, creating a wave of investor confidence that boosts the whole market. Take this data from early 2025 as a perfect example. In just 1 week, mixed earnings from only a handful of tech giants were enough to pull the entire S&P 500 down by 3%. That's the kind of ripple effect we're talking about. So, the million-dollar question is, how can you navigate all this volatility? How do you prepare for earnings season and maybe, just maybe, turn it into an opportunity? Okay, here's a simple, actionable playbook. First, do your homework and do it before the reports drop. Know the key dates, make sure your portfolio is diversified so one bad report doesn't sink you, and maybe most importantly, stay calm. Volatility is part of the game. Use it to spot opportunities, but don't let it force you into making panic decisions. By understanding these dynamics, you can fundamentally shift your whole perspective. The market swings during earnings season stop being a threat to be feared, and instead become a predictable event you can prepare for and potentially leverage. The information is all out there. The reports are public, the calendars are available, and now you have the framework to decode what it all means. The next quarter is just around the corner. The question is, what's your next move?